Hello traders, and welcome back to the Forex Kick. In today's video we're diving into one of the most reliable tools in technical analysis, which is double candlestick patterns. The best double candlestick patterns out there which you can use to trade the financial markets, with the Forex market or the crypto market. These patterns can give you powerful insights into potential trend reversals or continuations, helping you make more informed trading decisions. So whether you're a beginner or an experienced trader, understanding these patterns will provide you with an edge in the forex market. So stick around until the end of this video as we break down the most important double candlestick patterns and show you how to use them effectively in your trading strategy. So let's hop onto it. First of all, what are double candlestick patterns? Double candlestick patterns are powerful market patterns formed by two consecutive candles on your chart. These patterns are particularly valuable because they capture the psychological battle between buyers and sellers over two trading periods, making them more reliable than single candlestick formations. So when you are analyzing these patterns, pay close attention to the relationship between the two candles, the size of each candle, their position relative to each other, and their colors will tell you something important about market momentum. So the first candle, known as the signal candle, sets up the potential pattern, and the second candle, called the confirmation candle, either validates or invalidates the pattern. So what makes these patterns especially useful is their ability to keep you to help you identify potential market turning points. So when you spot a double candlestick pattern forming at a key support or resistance level, it often signals a high probability trading opportunity, and these patterns work across all time frame, from the 5 minutes chart to the daily chart, giving you flexibility in your trading approach. So let's go ahead and talk about the types of double candlestick patterns we have in the market. So each of these patterns, they have unique characteristics that can help you identify potential market movements. The very first is the engulfing pattern, which is this one here. This is the engulfing pattern. So I'm just gonna change the color of this. Exactly. So this is the bearish engulfing pattern, and this is the bullish engulfing pattern. It's just one of the double candlestick patterns, one of the best out there, and it happens in the market frequently. So the bullish engulfing pattern appears, which is this one. This is the bullish engulfing pattern. So it appears during downtrends, and you notice a small bearish candle followed by a large bullish candle that completely covers or engulfs the previous candle's body. And this pattern suggests that buyers have overwhelmed sellers. Potentially signaling an upward reversal, as you can see right here, where the bullish candle totally engulfed the bearish candle, signaling that the buyers have overwhelmed sellers, and we could be looking for a push to the upside. And conversely, the bearish engulfing pattern forms during uptrends. Here you will see a small bullish candle. Sorry, I think I should change these colors. I'm sorry about this confusion. So we have a small bullish candle, as you can see right here, followed by a larger red candle that totally engulfs that small bullish candle, as we can see with this example. Sorry about the colors. Yeah, but this is exactly how it looks like. There's a small bullish candle. It may not be that small, but as long as the next candle, which is the confirmation candle, engulfs this green candle, small bullish candle, it means that we may be looking for a bearish trade or bearish trading opportunities, and this pattern indicates that sellers have taken control, often leading to a downward reversal. So let's hop on the charts and look for the engulfing patterns. You can see one right here. This is the engulfing pattern, like this is the bearish engulfing pattern. See this green candle, and you have the red candle totally engulf it, and you have a confirmation also. We see this shooting star candle just right next to it. Multiple bearish confirmations, and if you want to use price action, you see that this is a major zone. I'm just gonna edit this, sorry. This is a major zone, and you see price reacting off of that. There's a major zone. As you can see, price reacted here to give us this push to the bullish, push to the upside, and we violated that zone, and price is coming to react to it as resistance. So you can see multiple confirmations and pullback, and the final push to the downside. So this is another engulf. This is a bearish engulfing. This was a channel, a bearish channel right here. This is a bullish engulfing. You see price, after we had this small red candle, we have the green candle engulf it totally, which confirms the bullish engulfing pattern, and you can see price pushing to the upside to hit the top of the channel, of the bearish channel. And the same thing happened here also. See this, we had this hammer followed by this bullish engulfing pattern to hit the top of the channel, and that's just about it. Before we had the breakout, actually that was a fake breakout because price later hit this channel again, and that's just about it. You can spot the engulfing. This is another one. It's very easy to spot in the market. You can just spot it anywhere, but you shouldn't trade it. You shouldn't just trade it. You should always confirm it with price action or multiple technical indicators, or you shouldn't trade it alone. You should always trade in line with the trend, and also trade with price action, support and resistance levels, and all of that. These are multiple engulfing patterns. You can see they all align with price action, and this a tap into support and push to the upside. So that is for the engulfing pattern. The next pattern in my list is the tweezer pattern. So we're going to talk about the tweezer patterns. So tweezer tops, they form when two consecutive candles have nearly identical highs, and the first candle is typically bullish, as you can see right here. This is for tweezer tops, and the first candle is typically bullish while the second candle is bearish, and this pattern suggests that buyers failed to push price higher, indicating a potential reversal. They have identical highs. You can see their highs right here is quite identical. The highs of the week, see the week tops of the week are quite identical, and the bodies the bodies could be different, but these highs just have to be identical. And the same thing with the tweezer bottoms. The tweezer pattern divided into tweezer tops and tweezer bottoms for bullish and bearish patterns. So you can see this is the same thing. The highs, the lows have to be quite the same. The highs may be different, the wicks may be different on the higher side, but the lows here has to be quite the same or identical. So that's how you can use the tweezer top. So let's go to the charts to spot this pattern. You can see this tweezer here. We have just a very identical candle here. You see they are quite identical, and the top doesn't really matter, but the body of the candles have to be quite identical. The lows of the candles have to be quite identical, and that is exactly what happened here. and that is a sign for a bullish push. That's a tweezer bottom. And let me look for another example. This is another tweezer bottom. It just shows that sellers have lost momentum and we may be looking to push price higher. See, this is quite almost the same lows right there, and we had this fake out though, and you should always watch out for fake outs. But after this fake out, we had the push to the upside right here. Now this is a tweezer top, as you can see quite identical highs right there, and it means that we should be looking for a bearish opportunity. If you check the support level, the resistance level, you can see that this is a major resistance level that I've been holding, and we might push to the downside, and the tweezer top right there confirmed it for us. If you use your Fibonacci tool from this top to this bottom, you can see this aligns with the institutional level, which is the 78.6 level. If you were to extend it, you see this is the 78.6 level exactly, and this is wonderful. Could enter a trade right there and target the next support level right here. That's how you can use the tweezer tops and the tweezer bottoms for your trades. So the next on my list is the harami patterns. So the harami patterns appears during downtrends. So look for the bullish harami pattern actually appears during downtrends. So look for a large bearish candle followed by a small bullish candle that fits entirely within the previous candle's body, and this pattern suggests that downward momentum is weakening. This is the bullish, this right here is the bullish harami pattern. So like I said, it appears during downtrend, so you look for a large bearish candle followed by a small bullish candle that fits entirely within the previous candle's body, which is the bearish candle. It fits entirely into its body without engulfing it or without going lower. Yeah, so it suggests that the downward momentum is weakening and we might turn bullish. And for the bearish pattern, it forms during uptrends, showing a large bullish candle followed by a small bearish candle contained within the first candle's body, which is the bullish candle in this case. And this pattern often indicates that buyers are losing steam in the market. So that is for the harami patterns, and if you want to look for it in the market, this is one example. Have this large bearish candle, and after this was a pullback, had this large bearish candle with the green candle inside. It fits entirely inside this large bearish candle, and it could mean that we are looking for we should be looking for bullish opportunities. You have this inverted hammer right beside it, which is a bullish pattern also, and that's a good confirmation to buy. And you can see price giving us the push to the upside. After that, this, you can see this was we were bearish right here, price giving us this, and as we tapped into this trend line, you can see this this bearish harami pattern here. We have a large green candle followed by a small bearish candle that fits entirely into the bullish candle's body, and after that we could be looking for push to the downside. Before we had this breakout, and had this breakout to give us a push to the upside. You can see this engulfing pattern, we've already discussed it. Is an engulfing pattern confirming that this breakout is valid, but we're talking about the harami right here. So we look for more harami patterns. You can see this one where this is a large bearish candle with the bullish candle that fit entirely into the bearish candle's body, and it wicked a little bit above it, but just a little bit. So we could look at these rejections. it means that we might actually be turning bullish. And this is you can see this zone right here, price giving us bullish order flow right there. This is a resistance don't support right here, this line from here, and you can see it giving us push to the upside. Here's another one. This is the harami pattern we are talking about right now. This is a bullish harami pattern where we had this red candle followed by this small bullish candle that fits entirely into the red candle's body and give us a push. We had that before this push to the upside, and that is how you can use the harami in your trades. You can see this one. This was a major resistance level right here, first of all. And then we have this large green candle, this large bullish candle with the bearish candle fitting. The bearish candle came after it, and it fits perfectly inside the bullish candle's body, and that is a bullish harami pattern, right? Bearish harami pattern, sorry. And after that, we could enter a trade. You see this rejection, so we could enter a bearish trade. Stop loss just above that resistance level, and I take profit at the support or any support level you want, or your custom risk to reward ratio, whichever one. So that is how you can use the harami patterns in your trade. And the last one we're going to be talking about today is the piercing line pattern. So the piercing line pattern is actually it's a bullish reversal pattern, and it forms during downtrends. So you will see a bearish candle followed by a bullish candle that opens below the previous close, which is the bearish candle's close, but closes above the midpoint of the first candle, which is this bearish candle. And this pattern shows strong buying pressure entering the market. It doesn't happen more often, but when you see it, it could be an indication that buyers are entering the market, and there's more buying pressure or buying momentum entering the market. So first you spot the bearish candle first, then the bullish candle, which opens below the close of the bearish candle and closes above the midpoint of that bearish candle. So that is how you can spot it, how you can identify it. Now you should know these are let me look for the major one. I think I had the major one marked out. I'm just gonna delete all this. So this is a major. This is how it looks like, but I didn't get it where we actually turned bullish. But you can see this right here. We were actually in a bearish trend, as you can see right here. We are in a bearish trend, and we had this piercing line pattern. It's a bullish piercing line pattern. The piercing line patterns are bullish candlestick patterns, and we have the red candle with the bullish opening below it, but closing above the midpoint. And how you can get the midpoint is if you use your Fibonacci to draw this from here, and you can see the 50% line, which is this line right here. And yes, the candle closed above the midpoint right there, so it means that this is a valid piercing line pattern. But the overall market condition, we were bearish, and we shouldn't be looking for bullish push. So if you go down to the lower time frame, after this you see this minor bullish candlestick, so you could look for opportunities to long to hit this trend line. So that's how it could be used there. And this is another one, but the bullish candle didn't exactly open below the red candle, so but this closed above the midpoint of this red candle, and it could be an indication that we should be buying. And this is another one right here. So we have this large bearish candle right here, and the bullish candle opened I closed above the midpoint of this bearish candle, and it could mean that we should be looking for bullish opportunities in the market. Remember, these are candlestick patterns and they should be used as confirmation tools and not exactly entry tools in the market, entry indications in the market, used for confirming your overall bias and used for looking out for trade opportunities. So let's talk about key tips for trading with double candlestick patterns. Now that you understand the different types of double candlestick patterns, let's talk about how to trade them effectively. So while these patterns can provide strong signals, it's essential to follow a few key tips to maximize your success and avoid common pitfalls. So the first is to always wait for confirmation before entering your trades. One of the most important rules when trading double candlestick patterns is to wait for the second candle to close before taking your trade, before making any trading decisions. So the first candle sets up the potential pattern, but it's the second candle that confirms whether the pattern is valid or not. So jumping into early can lead to false signals, especially in volatile markets. So wait for confirmations and ensure that you're trading based on solid evidence and not just speculations. So for example, you can see this bullish engulfing pattern. You want to see the second candle fully engulf the first one before considering a long position here. So the next tip is to combine this double candlestick patterns with other indicators like your RSI, your Fibonacci, or your moving averages, and they can help you confirm whether the market is truly ready to reverse or continue in its current direction. For example, if you use the moving average, let me just add the moving average here. So I have the moving average simple, and you can see this engulfing pattern right here. After we had this engulfing pattern, our price went above the moving average, confirming that yeah, we are bullish. And if I should increase this to the 21-day moving average, so now you can see this engulfing pattern at the moving average, and is using the moving average as a support to push price higher. Here we were below it, so we may be looking not to take this trade because it's below the moving average, and this trade might not be this engulfing pattern might not be a valid one. So that is one way you should look at it. You use it as confirmations, or combining the double candlestick patterns with moving averages to confirm your trades. So for example, you can see this bearish candlestick bearish engulfing pattern right here, giving us a push to the downside, but it's used the moving average as its resistance. We were below the moving average, so it was valid. It's a valid one to consider entering bearish positions. If we were above and we saw this, it wouldn't be wise to actually take the trade. Here we were quite bearish. We had this channel, price was ranging, so the moving average was ranging with it also. And we had this engulfing pattern just when price was about to cross the moving average, so it could be a valid one. And also combining this with maybe your Fibonacci from here to here, and you can see that this zone is reacting from the 78.6%, and we've already started going down, pushing price lower, and this was just an extra confirmation to continue the downtrend. And that's just how you can use these double candlestick patterns, by combining with other indicators. So the next tip is to focus on trending markets. In sideways or choppy markets, these patterns are more likely to give false signals because there's no clear direction for the market to follow. So when trading these patterns, always ensure you're working with a strong trend. For example, if you're trading a bullish haramis pattern, make sure it's forming after a clear downtrend and not during a period of consolidation. So that is just how you can use it. Like this was a haramis pattern, you see this was a clear downtrend, and that was how we were spotting this. You can see. So that is it. It's just not wise to use it at choppy markets. So it's wise to use it at clear trends. So you should focus on trending markets. So the last is you should be cautious of fake outs. In fast moving or high volatile markets, you should be cautious of fake outs. You can see one happened right here. And fake outs can occur where price action briefly forms what looks like a valid double candlestick pattern like it did here. This was a bullish harami, and but quickly reverses after trapping traders. See, there was a reversal here and it was very quick. You see this long wick wiping out all buyers, so you should be cautious of cases like this. To avoid falling into this trap, always look at the bigger picture and ensure that other factors like volume and trend strength support your trade idea. So if you're unsure whether the signal is genuine, it's better to stay out of the trade than to risk getting caught in a fake out. So those are your double candlestick patterns. We have the engulfing, we have the harami, the piercing line, and that's just it. So alright traders, we've come to the end of the video on double candlestick patterns. By now you should have a solid understanding of how these patterns can help you identify potential reversals and continuations in the market. So remember, patience is key. Always wait for confirmations and use other indicators to strengthen your analysis. So if you found this video helpful, don't forget to like the video, subscribe to the channel, turn on the notification bell so you never miss out on future trading tips and strategies. Thanks for watching, and I'll see you in the next video.